Good morning. I hope we are all fine. And I think this will be my final video concerning UGBS academics here. All right, so Rako here again, and in today's video, I'll be explaining the suggested answers I have for 2023-2024 past question and for management accounting, right? And I'll be specifically solving the distance education question in this video because for the main campus one, I think we've solved most of them during tutorials already, and I think I've also solved some here. So what you'll be doing is to solve the distance education on, and then if it comes in point, they are not actually, but and this is a suggested answer. It doesn't mean everything I'm solving here is correct. Maybe I might have some one or two mistakes. So if you could prompt me on it so that I will also learn, because I'm also a student and I would also like to learn. And as I'm always open to learning. Yeah. All right. So let me begin. Let me proceed. So first and foremost, if I've been instrumental to your academic journey, if I've been helpful to your academic journey and you would want to support me with any, because some of my friends will be like, why don't you let us support you with something? Yeah, yeah. If you would like to support me with something, I will be glad as well. One of the main reasons why I've not been able to be, like, I've not been very active here this semester was because my laptop is messing up, and I'm also facing some challenges. That's why I've not been able to buy a new laptop as well. So, pardon me for that. And if you be willing to support me, you can support me on 0244724495. And the name on the Momo is Rako Kofi, right? So I think I will be changing it back to Nehemiah Agbeti. But maybe I'm sure when I'm done with school. But for now, the name on it is Rako Kofi. So if you would like to support me with anything, I'll be glad. And then, yeah, because all right. So thank you so much for your support. And then I'll see you at the top. So let's begin. Let's talk about what we have today. All right. So now I always say that. So it is. So I always say that before you start every question as well. For me, during exams, I use the first 10 to 15 minutes to just go through all the questions and then look at what I can do very well first. Because it is very probable that I will not be able to do everything, right? So the ones that I can do first, that's what I start first to give an impression to the examiner, right? So to give a good impression to the examiner, I start with the one I can do well and do well, right? Before I move on to the other ones. Note that it's you might be able to complete all the questions, but it is very probable that you will not be able to complete all. You get it? So you could find ways and means as well to balance it, because the lectures even tell us in class that they know we cannot do all the questions. All right, so let's begin. So now this is normally 3 hours and the likes, right? And also they say what we are to answer and workings, like we have to show any answer in any workings, and then also new question must be on a new page. But in this video, because I'm actually solving it, I solved it in a book. Most of our mates was like, sometimes I would just have to just solve and then come and then send answers to them. But I know some will also need explanation behind the answers, right? That's why. So after this video, I will upload this as well on the Telegram channel, where you can download it there for free, and then go through it. Yes, I'll upload this as well in the Telegram channel. All right. So the link to the Telegram channel will be in the comment section. I'll pin it there. So you just go click on it and then you get the file straight. I'll send these two documents. It's already this past question is already there, but I'll resend it again and then I'll add answers. All right, enough of the talking. So question 1 is saying that CAM Limited manufactures and sells erasable pens at a selling price of 10 per pen. CAM Limited policy requires a profit margin of 25%, meaning that whatever cost they will incur, they will have what? A 25 profit margin on each product. Earlier this year, Chinese company offering a similar pen 20% below the price. So if the price is what 10 and they are offering this thing below it, definitely consumers will move towards them. So they enter the market. Now they are telling us to determine the cost that needs to be set for CAM Limited to remain competitive and still meet the company's targets. Now this is a target costing question. And then in the lecture videos, I made you understand that target costing is not difficult, right? It's more or less like reversing whatever you know concerning production to cost, the price. Here you are reversing the price to cost. You get it? So now, what I've solved here is just a rough sketch, so you can actually write it well in your books, right? So what we are having here is the actual price is 10, right? And then the competitor is actually selling it 20% below the 10. Now, when you find 80% or when you take 20% out of the normal 10, it will be left with what? 8. So 80% of 10 is 8. So meaning that the competitor is what? Selling the pen at 8 cedis, right? Now, since CAM requires a 25% profit margin, then the target cost will be what? When we take 25% or when we multiply 75% to the 8, we are going to get what? A target cost of 6. So when they make a target cost of 6, then they apply their 20% profit margin before they get what? Before they get their target selling price to be 8. You get it? So it's more or less like reversing everything backwards. But here we are changing the cost because now, since we are expecting a profit of 20%, we have to also make sure that our target cost will also reduce. So here, the final answer for this is 6. I didn't bring the Ghana cedi, pardon me. I didn't bring the Ghana cedi, so pardon me. 6 Ghana cedis per pen. Remember to always bring the signs during exams, right? If it is unit, bring unit. If it is this thing, bring this thing as well. CDs, bring CDs as well. So the final target cost is 6 Ghana cedis for the pen, right? All right. So 1B is also saying that. So that's the answer for 1A. 1B is also saying that work organization manufactures one product. The product has a variable cost per unit of 120,000 and a contribution margin ratio of 52%. Fixed costs for the month were 780,000 and the monthly projected sales for the product were 8,000 units. Now, they are telling us to determine the margin of safety and they use it to calculate the monthly profit of work organization. Now, boss, me bow, me your class. Oh, me your class. Oh, yo, Mate. So the work for the they are telling us to determine the margin of safety and use it to remember that the margin of safety is just the sales unit minus the break-even units, right? So first you have to find a break-even. Now when we want to find a break-even, we have to first find a contribution as well. Here, contribution margin ratio, which is contribution over sales, is what? 52%, right? So now contribution margin ratio So I broke down the variables here with the figures. Now contribution to sales ratio is equal to the selling price minus the variable cost all over selling price, right? So 0.52, which is the contribution margin ratio, is equal to x over x minus 120 over x, right? So basically, whatever we are trying to say here is that now we multiply, we are going to get what? 0.52x, and then we group like terms. We bring this 120 here and then this one here, which this x is having 1 already behind it. So 1x minus 0.52 is going to give us 0.48x. Now we equate it to our 120. We divide both sides by the 0.48, we get the selling price to be 50. Now if you have the selling price to be 50, then what it basically mean is that our contribution now is going to be the 250 minus the 120, which is the variable cost we have in here. Now, when we do that, you are going to get what? A contribution of what? 130. Now, break even is equal to the total fixed cost over contribution, right? Now, when we do it, we are going to get 6,000 units. I didn't bring the units again. Kindly add the units if it's exam. So 6,000 units. Now, they've given us the sales. Now, when we subtract the sales from when we subtract the break even from the sales, we are going to get our break even. So our break even unit is going to be what? 2,000. Now, they are telling us to calculate the monthly profit of work. So the monthly profit is going to be the margin of safety times the contribution. Now, when we do that, we are going to arrive at 260,000 Ghana cedi. Or if you want to do it step by step as well, you can find the sales. But here they told us to use it to calculate. Now that's why you did it. But if you want to do it step by step, then what you are going to do is you are going to do your normal sales, less cost of sales, and then you get your profit. Less cost of sales, less expenses, and you get your profit, right? But using the margin of safety, it's like this. All right. Now, question C is around break even as well. Now, this question, I think I solved it during tutorials, one of our tutorials. So let me re-explain here again. So Cow Cuisine primarily cook and sells 3 Ghanaian dishes, which is fufu, tuozafi, and akpleng. That's how I've illustrated them up here. Fufu, tuozafi, and akpleng. Now it estimates sales demand to be 4,000 balls of fufu, 6,000 balls of tuozafi, and 10,000 balls of akpleng. It plans to sell fufu, tuozafi, and akpleng for 30, 40, and 52, right? So 30, 40, and 52 as I've illustrated here. Now, they are telling us that Cow Cuisine has experienced significant variance in its sales output and variable cost over the past years. Its management accountant has decided to use CVP analysis to carefully evaluate the sales forecast for the coming year. The initial budget information for financial year ending is for the financial year ending 31st December 2024 indicates that it expects its total fixed overhead cost to be 260,000. The contribution margin ratio for each fufu is and akpleng is 40%. So fufu and akpleng is 40. So I've also wrote the contribution margin of fufu 40% and then akpleng 40%, and then tuozafi is 60%, and tuozafi is 60%. Now instead we should determine how many balls each of CAOK Cuisine delicacies must sold to break even. So this is involving what? BEP for multiple products, right? So now assuming the sales mix remain as budgeted, what would be the sales revenue for each dish? I think I've solved this here. Now let me go through again. Now we are having the demand here. We're having the demand here, and then we're having the selling prices here, right? Now if we want to get the variable cost, they've given us that the contribution margin ratio is 40% for this and this, and then the total fee is 60. So we can just go straight and then find the contribution. Now, when we multiply the contribution by the sales, we are going to get it. That's why 40% times the selling price is going to give us this contribution being 12. 60% times this price, 40, is going to give us this 24. And also 40% times this is going to give us this, right? So you put in that. Now our sales mix is going to be our demand, right? So you can use the demand to do that. Where the demand was 4,000, 6,000, and 10,000. I've cleared all the zeros. That's why you are seeing it like this. So our total mix is going to be 20. So when we take 4 over 20, and then we actually what? Multiply it by their contribution. So first one here, which is the 2.4 here. So this 2.4 we are having here as the Wacom here is going to be 4 over the total sales mix times the contribution. Also I had 2.4 here. Now the second one as well is going to be 6 over 20 times its contribution here is 24. So 24. You are going to get what 7.2. So you do the same thing as well for this, and then you get what 10.4. Now when we do that, we find our total break-even, the break-even in unit for them. Now the break-even in unit for them is going to be the total fixed cost, which is 260,000 divided by the total contribution margin we are having here. Right, the total contribution margin we are having for this was 20, right? It was 20 here. The Wacom, the weighted average contribution margin, when we add all of them, we had 20. So divided by 20. Oh, to compound hours there, no. So we had 13,000 units. It was 260,000. So 13,000 units. Right, so 13. Let me go and tell them to bring the sound down. So now, after getting that, we now divide the units based on their sales mix, right? So we had a total unit of 13,000 units. Now let's divide it each, right? Let's see how much fufu will get, how much akplen will get, and how much tozafi will get, right? So we are still following the same thing, fufu, tozafi, and akplen here, right? So if we want to see how much fufu will get, it's the same thing again, 4 over 20 times 8 mix, right? 8 mix times the total break-even points or units that we calculated, so 13,000. And this one you have 2,600. That's the same thing here. And the next one as well is going to be 6. 3,900. And the next one is also going to be 10 over 20 times the same 13,000 units. Now, after doing that, because the question told us to what will be the sales revenue for each dish, each dish, what we are going to do is we multiply the units by their selling prices respectively, right? So So now 2,600 times 30. Right, that's why I had 78,000. Do the same thing here, where it's going to be 3,900 times 40. You get this? Then here as well, 6,500 times 52, and you're going to get this. So this is going to be the selling prices for each. Right, I'm sure we are good up to this one. Now let's quickly move to question 2. I want to use less than 1 hour card also to explain this. Now let's move to question 2. So question 2 is more or less like a formula week. All right. Hey, all right, don't worry. Let's see. So CNOK Limited has three divisions. The home plumbing division manufactures copper pipes for trade person and home innovators. These areas of the economy are in decline. The home plumbing division operates with spare capacity and uses machinery acquired many years ago. The industrial pipes division produces pipes for heavy manufacturing industries involved in chemical refining and gas exploration. This division is machine intensive and using advanced computerized equipment to manufacture pipes to precise tolerance levels. The hardware division operates a hardware store. The following data relates to three divisions. The company minimum requirements required rate of return is 8%. The required rate of return is going to be used to compute our residual income. So we take note of that. Now, A is saying that we should calculate I up to XII. Right. So we start. I is return on sales. Where return on sales is profit over sales. Right. Now, it's supposed to be profit over sales. But since we are having it in percentages, it's prudent to also do yours in percentages. So we multiply it by 100%. Right. So profit here is 5,000. Then sales here is 5 million. Sales is 25 million multiplied by 100 and have 20%. So I is 20%. II is what? Investment turnover. Where investment turnover here is in times. So it's advisable you also leave your answer in times. Investment turnover is sales over average investment, where we are having sales here 25 million over average investment 10 million, and we are getting what? 2.5 times. Now, the next one we have to calculate here is return on investment, ROI. Return on investment is profit over average investment. And since we are having it in percentages here, the advisable you also leave your answer in percentage. So you multiply it by 100%. Now, profit here is 5 million as usual. Investment here is 10 million as usual times 100%. So we are going to get what? 50%. Now, residual income here is going to be profit minus into bracket the required rate of return times average investment, as we know, as usual, which was I think was explained in the last video or last two videos, right? So now for that one is profit minus the required rate of return times the investment. So we put them into bracket. So profit is what? 5 million minus 0.08, which is 8%, times the average investment. When we do that, we are going to get 4.2 million. All right, so 4.2 million here. Now, we move on to V, which start from the industrial pipes. We are being told to find revenue, right? Revenue here is what? Revenue, we can't get it straight from here, but we can use the return on sales to find revenue. Where the return on sales is profit over sales. They've given us return on sales to be 20%, and they've given us profit to be what? 1 million, sorry. So basically what is going to happen is that it just means that profit sales is going to be return on sales times profit, right? No. It's going to be return on sales divided by profit. Return on sales divided by profit. What is here? Oh. Right. So sales is basically going to be profit divided by the return on sales, right? So what we are getting here is the profit here to be 1 million up here, and then 1 million up here, and then divided by the return on sales. So it's going to give us what? 5 million as sales, right? So that's just changing of subject. We bring in the sales here, and then we bring in this one here. That's why we are getting this. So we are getting 5 million Ghana cedis. So always remember to bring the cedi sign as well. Right. Now, the next one we are having here is average investment. So average investment also is not here. Now we have investment turnover. And we know investment turnover is sales over investment. So since we've gotten sales, we can actually do what? Find the investment turnover. We can actually find the average investment, where investment turnover is sales over investment, and then that investment turnover is 0.63 here. So 0.63 is equal to the sales, 5 million over average investment, right? So what it means is that sales divided by the investment turnover is going to give us average investment. So I'm having the investment here, X, is equal to 5 million divided by 0.63. And then I had 7936507.97. So approximately I had 7936508, right? Because I just kept it in whole number, because looking at it here, whatever we're having here is in whole numbers. So I took out the decimals. All right. So now we move on to VII, which is return on investment. Return on investment is basically net profit over investment. We have the net profit to be 1 million, and investment to be what we just calculated up here. Now, because of that, you are getting 12.6%, because everything here is in percentage. So you have to also, it's advisable you also put it in percentage. Now, VI is residual income, which is basically net profit minus the RR times the average investment. Now, doing that, we arrived at this 365079.40, where we are seeing everything here to be whole number. So it's prudent we also keep it in whole number. So I round it, and then it was 365079 Ghana cedi. Remember to put in the Ghana cedi, because I was actually writing fast. That's why you are seeing it this way. Now, now, the next one we have to do is IX. XIN, XII. Now, we can, for me, I started from XII, because I can get some multiple variables and then find out, because if I don't get the investment, it will be difficult for me to find the rest. So I started with the investment. Now, investment, for me to find the investment, look at it. I look at two formulas where I will see investment in there, and then now I'll replace one with one. Now, return on investment is equal to profit over investment, right? Now, here, if I want to see everything, then if I want to make profit a subject, then profit is going to be what? ROI times times investment, right? Now, since I have ROI here to be 12.5%, I multiply it by the I. So I'll be getting what? 0.125I. Now, I come to the residual income as well. Now, I have residual income figure here to be 180,000, right? So residual income is also profit minus 0.08 times investment, right? Now, I propounded a profit formula here being 0.125I. So I bring it in here. I bring the residual income value in here as well, minus this. So now when I multiply what's in the brackets here, I get a 0.08I. Now when I subtract it from the 12% I, I'm going to get 0.045I. Now, because I have residual income, I divide both sides by 0.045, and then I get what? 4 million for the investment. So XI is 4 million. Now, since I have that one, I'll be able to do the rest, right? I'll be able to do the rest. Now, if I want to find X, which is profit over investment is going to give me ROI, right? I have ROI to be 12%, and I have investment to be what? I have investment to be 4 million now. So if I multiply the ROI by the investment, I'm going to get what? The profit. So now profit is going to be 500,000. So X is 500,000. Now, return on sales here as well is going to be profit over sales. Now I have profit here to be 500. So you see, if you don't solve one, you'll not be able to get the rest. So you have to solve for the one that they have some clues for you here before you move on to the next one. So return on sales, which is XI, is going to be profit over sales, right? So so sales is going to be profit over ROS as well. So profit is 500,000 divided by the ROS is what? 0.25%. 0.25. Oh, hmm. Me kwa je fight ano patututu we kwa fight aba. Ah, Tale. Okay, I'm sure say the sound is not that loud. Me kwa fight second one be more. Hmm. So now the return on sales, as usual, profit over sales. So now sales is going to be profit over return on sales. And I had what? Sales to be 2 million. Now I can do the rest, which is XI, which is return on sales as well. I've done return on sales. I think return on sales was given already 25%. So investment turnover is the next one, which is X. XI is average investments, right? So investment turnover, which is XII, sorry, XII, which is investment turnover. Remember, sales over investment is what? Investment turnover. But since it is in percentages, we leave it in percentage times 50%. 8 times 100, giving us 50%. So the sales is 2 million, investment is 4 million, and we have what? 50% on investment turnover. So that is it for this one. Now for the difference between profit centers and investment centers. Profit centers actually look at or focuses on revenue and cost to get their profit, right? But for investment centers, what they do is they use this profit to invest in other assets, right? Or other assets to actually drive the long-term success of the business, right? So now they are saying state any three advantages of non-financial performing measures. So non-financial performing measures like understanding customers, like listening to customers complain and then improvements in production, those kind of stuffs, no, they actually improve or help align departmental goals with company strategic objectives. They also often measures or review issues that are actually not uh, improving the financial statements, because if customers are giving you complaint that your product is not in a good quality and the likes, you are actually going to work on it to improve it and the likes, right? So yeah, so you can just read it. You can just read it for this one then. Now let's move to question 3. Question 3 is where yeah, this is the, I think when I was solving, this is the most technical part, right? And question 4. So this and question 4 is the technical part. But I think for question 4, I wasn't able to complete. So me the major tool. So maybe if you have a full answer for question 4, you can also help me with it so that I learn it. So now for question 3, define a cash budget and explain why cash budget is essential for organizations, right? Cash budget is a budget or is a plan that estimates inflows and outflows of cash within organization at a particular period of time. So some of it can be that it helps you keep like them and like an important amount of cash around you. You don't just keep any idle cash and like, so it helps in controlling, helps in preventing idle cash, helps in prevent shocks, in the sense that let's say you need cash urgently to do something. But since you know that you've been able to plan the amount of cash you are going to receive, maybe you'll be able to meet that shock kind of expenditures and stuff. Now, the B here is is the technical part. So the B here is saying that NK Gok Limited Company manufactures and sells a product with seasonal variations in demand, with peak sales coming in the third quarter. The following information concerns expected operation for the year 2024 and the first 2 quarters of 2025. The reason why they are giving us the first 2 quarters of 2025 is for us to be able to compute some other stuffs that are far ahead of us. We'll be able to compute some of the material stats that are ahead of us. Now, these are the information we're having. So the company's single product sells for 8 Ghana cedis per unit, and the budgeted unit sales in units for the next 6 quarters are as follows. So they have 40,000 units, they have 60,000 units, and they have 100,000 units, and 50,000 units and 70,000 units. So they are saying that 40% of each quarter sales are cash sales, and credit sales are collected in the following pattern: 75% in the quarter 8, in the quarter in which the sales are made, and the remaining 25% in the next quarter. On 1st January 2024, the company statement of financial position showed 65,000 in account receivable, all of which will be collected in the first quarter of the year. Bad debts are negligible, right? So meaning that there is no bad debt and can be ignored. The company desire an ending. So here we are talking. So you see, what I would want you to do if we meet a similar question is that first just read everything. Now you take one, you work on it before you move on to the next one. You take the first point, work on it before you move to the next one. Take one, work on it before you move to the next one. So the second part is saying that the company desire an ending inventory of finished goods units at the end of each quarter, equaling 30% of the budgeted sales for the next quarter. This requirement was met on 31st December 2023 in that the company had 12,000 units to start the new year. So 5 kg of raw materials are required to complete 1 unit of production. The company expects an ending inventory of raw materials on hand at the end of each quarter to equal 10% of the next quarter production needs. This requirement was met on 31st December 2023 in that the company had 23,000 kilograms of raw material to start the new year. The raw material cost 0.8 per kg. One half of purchases of raw material in each quarter are cash purchases. Purchases of raw material on account are paid for in the following pattern: 60% in the quarter the purchase was made, and the remaining 40% in the next quarter. On 1st January 2024, the company's statement of financial position showed 81,500 in accounts payable for raw materials purchases, all of which will be paid for in the first quarter. Now, we are required to prepare the budgets and schedules for the year 2024, showing quarterly and total figures, a sales budget and a schedule expected cash collection, a production budget, a direct material purchase budget, and a schedule of expected cash payments for material. Now, reading the requirement, you see they want what? A sales budget. They've even given us the step-by-step. Sales budget, cash collection, production budget, direct material purchase budget, and a schedule of cash payment. So I started with the sales budget, and the sales budget was located in the additional information II, the information II. 40% of each quarter sales, it's the sales budget is in I. It's in I. Now, the product sells for 8. So we bring in the selling prices here respectively. Now, they are telling us that these are the units we are expecting to sell. So let's bring the units here. Because we are doing it for only the first quarter, right? That's why I'm doing it quarter 1, quarter 2, quarter 3, quarter 4 here. And the total here for the unit is going to be the total of it. Now, when that one is, so in terms of revenue, you multiply what the budgeted units by the sales, by the selling price. We get the sales for this one, we get the sales for this, we get the sales for this, we get the sales for this. If papa in this one, because so now this is what we get here. This is what we get here. This is what we get here. When we multiply, when we get the sales unit for all of them, getting a total of 2 million Ghana cedi, right? Now, after we have the sales, now let's look at our expected cash collection. Now, remember that they said that the cash, when we sell instantly, receive cash, 40% of it, and then the rest will be 60% on the same quarter. The 60% that is left, we are going to collect 75% in the same quarter and 25% in the next quarter. So now, when we sell 320,000, we receive what? 120,000 instantly. When we sell 480,000, we receive 192,000 instantly. 800,000, we receive 320,000 instantly. And when we sell 400,000, we receive 160,000 instantly, right? And that's the 40%. So 0.4 times 320,000. So that's why you're having a 120,000 here. You get it. Now they are saying that the remaining sales, 75% of it will be collected in the quarter rate it was done. So what is going to happen is this. What's going to happen is this. Our total sales was 320,000 minus the 40% that we are going to take. Right. Now they are saying that 75% of it will be collected in the same quarter. So we multiply it by 75%. And this is what we are going to collect in that same quarter. So credit sales collected in the same, in the quarter one, we are going to get this. Quarter two as well. You take 480,000, you subtract the cash sales from it, and then you find 75% of the balance, and you are going to get this. The same thing will be done here. If in case if you have some questions as well, you can hit me in DM because I want to finish this quick. All right. So the same thing will be here, 800,000 minus 320,000. The difference you get, you find 75% of it, and that will be collected in that same quarter again. And the same thing will be done here as well. 400,000 minus 160,000. The difference, you multiply 75%, we get the cash you're going to receive in that same quarter. Now, we move on to add up our opening balances. So the question told us that the company statement of financial position showed 65,000 account receivable last time. No, I can't afford any, and they are going to receive it in the first quarter. So that will be the opening listing for the first quarter. That's going to be the opening listing for the first quarter, right? Now, for the next quarter, the opening is going to be the amount that they were not able to pay last quarter. So what is going to be is this. 320 minus 128,000 minus this 144 that we collected in the same, and we had 48,000. That's why we are seeing this 48,000 here. Right. So that same thing will be applied here as well. 480,000 minus 192,000 minus 216,000. We are going to get it here because it's a closing this thing owings, because that's the same thing the question said, that 25% will be collected in the next quarter, right? So it becomes an opening this thing for the next quarter that you are going to receive, right? So we do the same thing for all of them. We add them, and then this is going to be our total cash, right? Now the next thing is to look at our production budget, because you see this one, this is the, so now what I'm just trying to say is that the first one spoke about the sales budget, we've done it. Move on to the cash received budget, we've done it in II. Now the third one is talking about the production budget, and it's saying that the company desire an opening and ending inventory of finished units at the end of each quarter equaling 30% of the budgeted sales for next quarter. So quarter two's amount, and you find 30% of it, and then it will be an ending inventory for quarter one. You get it? And since it's an ending inventory for quarter one, it's going to be what? An opening inventory for quarter two. That's the same application. We did this during the budgeting question that I solved. We did a similar thing like that. So this requirement was met on 31st December 2023. In that the company had 12,000 units in the unit to start the new year, right? So basically, when you come on the production budget, remember our production budget is going to be what? Our budget, we are going to produce based on the unit you want to sell. So we normally start with what? Our budgeted sales unit, 40,000. Now we want a closing stock of the next quarter's budgeted sales, which is 30% of it. So that's why we are having this 0.3 times the next budgeted sales here, 18,000. And that's the closing stock here. So we add closing stock, then we less opening stock. Now opening stock was given here. Opening stock was given in here 12,000. Now since opening stock was given in here, what is going to happen? Now I want to sound a caution here that I will advise that you also go through the ICA management accounting questions as well. That's where most of the questions are being, they copy some from there and then they give it to us. So you go through it, they have answers already. So when you search ICAG 2025 sitting, past question for management accounting, you get it plenty on Google. Then you download, you go through, you solve some, you solve, so. All right. So now, there's it here. Now, that will be our close. So first of all, what I did first was I brought in all the budgeted sales units. I worked on the closing stocks because this is going to be 30% of the next one. This one is also what this quarter two's closing stock is going to be 30% of quarter three. Quarter three's unit is 100,000. 30% of it is going to give me 30,000. Now quarter three's closing stock is going to be what 50,000. 50,000 times 30% is going to be 15,000. That's the closing stock here. Now, quarter four's closing stock is going 30% of quarter five. This is the reason they give you quarter five, even though you're not going to use quarter five. One of them is this. Now, 70%, 70,000 times 30% is going to give what 21,000. That's what we're having here. Now, the opening stock is going to be just be the closing stock for the next quarter, for the quarter. So the quarter one's opening stock was given. Quarter two's opening stock is going to be the closing stock of quarter one. Quarter three's opening stock is going to be quarter two's closing stock. Quarter four's opening stock is going to be quarter three's opening stock. You get it? So we do all of them. So we add closing stock with less opening stock. We add closing stock. We add closing stock, then we less opening stock. Right, then you're going to get production requirement to be 46,000 units, 720,000 units, 85,000, 46,000 units, 73,000, 85,000 units, 56,000 units. Right. So if we were to be given cost of production, we could have multiplied it as well and then get the production cost and kasa. But we are going to get it down here. And this is going to be our total here. Now, this is where some people might get a bit confused, but just open your eyes, right? Open your eyes. We are going to do this. Now, the IV is saying that, so you see the II was production, the IV is saying the direct material purchase budget or the direct material budget. So they are saying that 5 kg of raw materials are required to complete 1 unit of product. The company expects an ending inventory of raw material on hand at the end of each quarter. So 10%. They want 10% closing stocks of the next quarter production needs. So this requirement was met on 31st December 2023 in that the company had 23,000 kilogram raw material to start the year. So now we know that before we will have the materials we want to purchase for production, we have to know how much we want to produce. That's why we saw the production budget up there. And then these were their respective units for the production requirements. Now, the material required to produce each unit is 5 kg, 5 kg, 5 kg, 5 kg for each of them. Multiply and then we get our total material we need. The total material we need, the material we need without adjusting the closing and opening stock or of material is going to be these ones here. Now, when we move on further, you now what? Add closing stock and then less opening stock. Now they are saying that they want what? 10%. The opening stock should be what? The company expects an ending inventory of raw materials on hand at the end of each quarter to equal 10% of the next quarter production. Right. So now, the next quarter production for raw materials, no, this quarter's production is 230,000. And then this one is 360,000. They want 10% of the next quarter. So 10% of this 360,000. This is the next quarter raw material. Right. So 0.1. That's what we are having here. 36,000. So I have 36,000 as a closing stock here. Closing stock of raw material. Now the same thing here, 10% of the next one. So 10% of the next one is 425,000, and we're having it here. The same thing you're having here, 10% of the next one. 10% of the next one is what you're having here. Now your problem is what you are going to look for, where you are going to get confused a bit is here. The quarter for the next one here. How did I get this? How I had this was I now do the pitches for the fifth quarter. I do the production budget for the fifth quarter, right? And the production budget for the fifth quarter is going to be, the unit you want for the fifth quarter is 70,000, right? The unit you want for the fifth quarter, that's what I've done small up here because it was a rough work, so I didn't really. So fifth quarter is here. You want this sales, this unit. Now, since we want this unit, then what's going to happen is what? We add our closing stock and then we less our opening stock. So opening stock is going to be closing stock is going to be 24,000 because of what we were saying here that what was 30% of what the next quarter. So the next quarter is this thing here after quarter 5 is what? Quarter 6. So 30% times it is going to be this 24,000. I'm having small up here. Now the closing this thing for the closing stock for quarter 4 is going to be opening stock for quarter 5. Now that's what I'm having here, 21,000. Now when I subtract, then what I'll need for production is going to be how much is it, Campo? 73,000. Right, I'm going to have 73,000, which is 70,000 plus 24,000 minus 73,000. Now, when that happens, this is the production I'm getting. This is what I want to produce. Now I come to the direct material here, right? And the direct material is also saying that for quarter 5, I want to produce 73,000 units. And what do we want now? Yeah. Now, if I want the total materials, it is going to be what? The production times the 5 kg that is required per material. I'm going to get the total material to be 365,000, right? So now, when I find 10% of this 365,000, then I'm going to get what? 36500 as the closing stock. So you see the kind of stress I went through to get this. It's not easy. It's not easy. So that's what I had here. Now, opening stock will just be the closing stock for the previous year, the closing stock for the previous quarter, the previous distance. And for this, the first opening stock was given to us in the question, 23,000 here, right? So it was given to us here, 23,000. Now, when we actually do what? This one's own as well will be the closing stock for the previous quarter. This one will be the previous quarter as well we are having. And this one will be for the previous quarter. And now when we subtract and add, this is the figures you're going to get. 243,000, 366,500. Then we have 4,105,000, 288,500, right? Now they are saying that the cost per this thing is what? So we are including the pitches, the material needed, and then the price of the material. So the total material cost multiplied by their respective cost per kg. Now we get the value for this, the value for this. So the total material cost for the whole year or for the quarter is going to be this. This question, I think I dreamt that it will come, something like this. Something similar. I dreamt I was solving a question like this. Way back when we were starting the semester, and I decided to go through the past questions before we start the semester. Yeah, I think, and then we do it. So now this is the material cost. This is the material, this is the amount of material I'm going to buy for first quarter, second quarter, third quarter, and fourth quarter. Now, what is happening here is that since we have the cost of material, we can now do our schedule for expected cash payment, amount of cash that we are going to pay. Now they are saying that we pay 60% in the quarter, we buy the item, right? So they're saying that 60% paid in the quarter the purchases are made. Here is supposed to be purchase. Sorry, supposed to be purchase, right? And then 40% paid in the next quarter. So now what's happening here is we have the cash, the purchases that we are going to first quarter are going to purchase what? 194, right? 194,400. Now 60% will be paid in the actual month, right? So we have 60% of that. Yeah. Also, I'm getting this. Now, what this is trying to say is that the difference will be collected in the next distance. So 194400. That's the difference. That's why it is collected in the next one. Now, this month's own is 273,000. 293,200. So you find 60% of it, we pay it instantly. Then the remaining will be paid in the next quarter. So the remaining is what you're having here. This one as well is what? 230,800. 60% will be paid instantly. And then the difference will be paid in the next quarter, which we don't have a next quarter yet, so we leave it like that. So this one's own is this. You find 60%, which is this. The difference will be paid in this quarter, right? And this 81,500 is in the question, right? So we are going to pay this here. That's what we're having. We add all of them. expected cash payments is going to be this, in a total of 10,000, 10, 1,000,000, 1,035,908. That's it for that one. Now, sorry for the hands. Why? I'm fine, Sana. Let me try and intend them. No, so now let's move to question 4. Question 4 is where it's tricky as Charlie. What I did was first, okay, the mommy read the question. Chartered Limited is a small company which manufactures and sells 3 different natural juices: Ibiza, Sobolo, and Sanko. Sanoko is the thing. All the 3 products use a specialized raw material, kakadro, and the manufacturing process of the product requires the same skilled labor. Chartered Limited Management is planning its production schedules for October 2024. The planning process is complicated because there are labor shortages in the community and the yield of kakadro is usually low in October. Management therefore expect that in October, 6,000 kg kakadro will be available for suppliers and skilled labor hours will be limited to 5,500 hours. Chartered Limited management practice a just-in-time system, so it barely keeps inventory in store. Management estimates the cost per kilogram of kakadro to be 4 and the wage rate per hour to be 8. The following expected relevant data for July has been assembled by management. Selling price here, variable to sales ratio, variable over sales, this is the ratio. Then component of raw material per bottle, labor hour cost, this is the component you have in here, expected sales demand. And you're saying we should determine the production sales schedule mix. Chartered Limited should select to maximize CD profit. This question is doing me two. I'm doing two whether I should use, because here it seems that they didn't mention any limited factor, except we have will be available here is limited, and then we have 5,500 will also be limited. So I'm contemplating whether to use throughput accounting method or to use the normal limiting factor method. But here we are having some kind of 2 variables, 2 limited variables, right? So unless maybe we use linear programming. So what I just did was in exams, what I'm going to do is I'm going to do this and then do this down. Then I'll also try the throughput accounting. I'll use the throughput accounting technique. So since I can't use this thing here, so for throughput accounting technique, you have to first find throughput contribution. So throughput contribution is not this. This is the actual contribution. But let me see if I can do the throughput contribution. Let me try and then solve that one. I should solve and upload. So for throughput, to find a throughput contribution. So throughput contribution says that only material is a variable cost. Oh yeah, girl. Thank you, Jesus. All right. So now we look in for sales. So we're having Ibiza, Sobolo, and we have Sanokwe. We have their selling price. Now, for throughput account, only material cost is this thing. So now we are having variable cost. Variable cost to be, the question gave us this. So they said that variable cost to sales ratio is 8, 0.8, 0.8, 0.8. So what you are just basically going to do is to multiply 0.8 by the sales to get the variable cost. So 4.8. You can also try the rest yourself. Or we're having the figures here. 4.8, 6, and then 8. Now, we have that. Now, the question further on said that raw materials is 50% of variable cost for this, 40% of variable cost for this. So I mean that the variable cost we have for Hibis, 50% of it is for raw material and 50% of it is for labor. Here, 40% is for raw material, 60% is for labor and the like. So I'm just coming to put the same thing here. So 2.4, 2.4, and then 4.8. Right. Now, I find my throughput contribution. Throughput contribution is only this, the selling price minus raw material cost. But they said that one is the only variable cost, right? So so leave the variable cost and kasa out. So throughput contribution A minus B, right? So here is going to give us, I think, 3.6. And 7.45 minus, so I'm sure you're going to get around 5.1. And then this is going to give us 6.2. So this is our throughput contribution, right? Now, after getting this throughput contribution, we have the order in which we are to produce this. I'm coming. So after doing that, then we bring in our labor cost. It's just a suggested answer. Maybe it might be wrong. So we bring our labor cost, which they said that it is what 50% for a variable cost for the first one, 60% and 40. So I'm bringing in 2.4, 3.6, and then 3.2 respectively here. So we divide. When we divide, then we get our return per factory R, right? So we divide. So let's say this is C. Oh, no, let me just say this is T. T divided by T, right? So 1.5 approximately 1.2, 1.42. So now, when we are to use throughput accounting, this is what we are going to produce first. This one second, and this one third, right? Based on throughput accounting. Now, we don't know. Okay, then I think I can use throughput to do this. So, maybe the way I'm doing cramba metrim be so. So now let's look at the material cost per unit for them, like the amount of material we are going to use for each of them, right? So cost for each of them. So for Hibis, they said that the material cost and casa is 4 CD for Kakadro, and the wage is 8 Ghana CD per hour. So due to this, let's look at the amount of kg that will be required or will be needed to produce each of them. Since we have their labor cost here and their material cost here, we can find that. So when we divide the material cost per unit, as we're having in here, by their respective prices here, we are going to get the kg we need per this thing. So here, this first one is going to be 2.4 divided by 4. We are going to get 0.6 kg. The second one is going to be 2.4 over 4. We are going to get 0.6 kg. Question number bottom. The next one is going to be 4.8 over, and it's going to be 1.2 kg. So the distance they require for each material is going to be 0.6, 0.6, and then 1.2 kg. Now let's look at the labor hours they will also use. So now the labor hours they will also use, they are going to divide it, their labor hour cost, the labor distance cost per distance by the total distance that we are having in there. So 2.4 over 8, right? 2.4 divided by 8. And this one is going to be all right. So right now it will need 6 kg, 0.6 kg, 0.6 kg in this to produce each of them. Now let's go back and then look at their demand. May check because I've not gotten an idea here. That's why. So if we are to produce, we establish that for throughput accounting, let's produce this one first. What's that one called? Sanokwe first. Now Sanokwe is 1.2 kg and then this. So Sanokwe and produce their respective demand. Sanokwe was 4,000. Sanokwe was 4,000. This was 3,000. So Sanokwe so for total hours, total material is going to be 4,000 times, it uses 1.2 kg. Total hours is going to be times the per hour, 0.4 hours. So since I have this, let me move on to, so with this one, the material left will be equal to, maybe it was 6,600. Okay, 6,000. This 1,000 minus 4,800. We are going to be left with 1,200 kg. Now, wait, that's an idea. I want someone maybe dream management on. You know, dream a war. So the hours left for the first one is going to be, and we'll move on further to produce the second one. Move on further to produce the second one. So the second one that we should have produced this. Wow, I think I'm getting new ideas for this question. Okay. So I just realized that. So I'll solve question 4 again and I'll upload it. Because for question 4, the limiting factor here is only raw material. I'm wasting my time. It's only raw material, so we won't use throughput accounting. Right? I will solve it again. I'll solve it again. I'll solve it again. So I'll now find the contribution because the labor hours, it will reach. The labor hours will reach. And then it's the material that is limiting here. So I will do it. Other limiting factor on only the material for the hours. Best one. Question now confusing me. And try away. So I will do that one and then I'll come back again. Maybe I'll solve that one separately. All right. So looking at it is only the weapon. Because if I'm to include it in this video, okay, let me include it in this video. Belong. So let's move to the next question. So the next question here is under standard cost and variance analysis. All right. So that's question 5. So EAOK Limited manufactures a special product, Vegemite, with standard variable marginal cost, 75 Ghana cedi per unit. Produce a standard. So this is basically similar to what I did in the slide. It's similar to that question. The standard variable marginal cost per unit is made up of direct material 15 grams at 3 Ghana cedi per gram. Direct labor, so this is smaller than the standard cost card. So direct labor 5 hours at 4 Ghana cedi per hour. It is 20. When we multiply, get 20. Variable manufacturing overhead as well is this. Standard selling price per unit of Vegemite is 100 and the monthly budgeted production is 1,000 units. The monthly fixed cost is estimated to be 5,000. During July 2024, the actual selling price per unit of Vegemite was 102, and the company also produced 1,400 units of Vegemite in the month. The other actual resource utilized and cost incurred in July 2024 were as follow. These are the actual figures, right? So now we are required to calculate all the relevant cost and revenue variances. Now, since we know what is entailed in budgeting, we know budgeting will have, if we want the revenue, we want what the sales variance, the sales budget. And if we want the cost, we want the production cost, we want the material, which consists of the material cost and then the labor cost, right? So that's the variances you are going to calculate. So let's first begin with the material price variance. So the simple trick I can give you here is that if you are solving for material price variance, actual quantity should be outside, then the price variances should be inside. The standard price and the actual price should be inside the bracket. That's a simple trick I can give you. So actual quantity is outside times standard price into bracket, standard price minus actual price. So standard price we are having here for material is 3. And then actual price report is 4. So now the intuition here is not what is in which one comes first and which one comes last. The intuition here is we are comparing the actual to the standard. When it comes to expenses, when the actual is less, it is favorable. But when the actual is more, it's unfavorable. So looking at it here, we can see that the actual is more than the standard. That's why our answer came out as what? Adverse. It's unfavorable. Now, we move to material usage as well. So you see price was inside. Usage, quantity will be inside. So quantity, standard quantity minus actual quantity, you can do it any way around, just that you just have to know the intuition behind it. Now, standard rate we are having for material is what? Material usage. Yeah, the standard rate we are having for material here is 3, right? It's 3 Ghana cedi. Now, the standard quantity we want or we are likely going, like we have here, was 15 grams times the actual unit you produce here, right? Which is 1,400. So when we multiply that one, we get to 21,000. Now, our actual units of this thing we used is what, 22,000 grams. So when we subtract, because the standard is less than the actual, it's what, because it's an expense, it's what, it's an adverse. So when we multiply, we get an adverse. Now, the labor as well, when we want to talk about labor rate, actual hours will come outside and the rate will be inside. Now, the rate, we compare the actual to the standard. Now, because it's an expense as well, we are expecting what, actual to be less, but when actual is more, is what is unfavorable or is an adverse. So here, actual hours is outside. Here is the actual hours. Standard rate is here 4, actual rate is here 5. Now, when we do the everything, you're getting what, an adverse, because the actual is more. Now we move to labor efficiency. Labor efficiency as well, we have the standard rate outside and standard hours used inside, right? So we have our standard rate to be 4, as we are having here. Now, the standard hours we should have used is 5 times 4,400, giving us 7,000, and then minus our actual hours we used. And because in terms of hours, we use less hours than expected, we are more efficient, so it's favorable. That's why the difference here is favorable. Now, this question back here, Shimmy, I should have gotten this. I think I'm doing some. So variable overhead efficiency as well. Here is the variable overhead absorption rate and the standard hours minus actual hours as well. So the variable overhead here is 2. The rate is 2, where the standard hours is what we computed up here, 5 times the 14,000, 1,400, sorry. We had the 7,000 minus the actual hours, we had 400 favorable. Now, fixed overhead as well. Budgeted fixed overhead minus actual fixed overhead. Budgeted fixed overhead is what? 5,000 minus the actual fixed overhead is 6,000. And that's why you're having what? An adverse, because the budgeted is less than the actual. Now, we move on to the fixed overhead efficiency, where the standard hours of actual production is subtracted. We subtract the actual labor hours from it, so times the fixed overhead absorption rate. Now, the fixed overhead absorption rate is what we are having here, 5,000 divided by 1,000. And then our standard hours is the 4,400 times 5. We get, and then we subtract. This is what we get as favorable, because the efficiency, we use less hours than what we budgeted for. That's why you are getting a favorable one here. Now, fixed overhead capacity rate will also come in, where is the actual labor hours minus the budgeted labor hours. Actual labor hours is 6,800. That's what we use. And then the budgeted labor hours is 5,000. Because when we multiply this 5 hours by the number of units, we are going to get what, 5,000. Now, when we do, the difference becomes favorable. Yeah. Now, Move on to the sales margin price variance. I've explained all of them in the video. That's why I'm not re-explaining whatsoever here again. So here, it is basically the actual selling price minus the standard selling price, right, times the quantity. So what's going to happen here is that the actual selling price here, we have 102 minus the standard selling price 100 times the quantity. That's why we are having this. So look at it here. We were supposed to charge 100 and now we are charging 102. So it becomes favorable for us. That's why 2 times the difference times this is giving us a favorable balance here. Now variable overhead expenditure variance, which I should have computed up there. I'm a fee here. Okay. Yeah, I should have computed it up there. Here. So that one is also budgeted variable overhead minus actual variable overhead. Now we have budgeted variable overhead to be 6,800 hours times the variable overhead. It is going to be 2 per unit per hour minus the actual rate. Actual is 11,000 hours. Now when we subtract, we can see that actual is less than our budgeted, so we get a favorable listing of 2,600 favorable. Now our budgeted profit is going to be our standard margin times our budgeted production, and the margin we are getting here is 20 because when we subtract the budgeted we are going to get here is 20. The standard margin is going to be 20. When we subtract the selling price, then subtract all the costs from the selling price, we are going to get 20. So we subtract the variable cost, which is 75, and then we subtract the fixed overhead cost per unit, which is going to be 5 from it. You are going to get 20. When that happens, we come in and do our reconciliation for budget. Now, the reconciliation for budget is more or less like the normal. This once you get your budgeted profit, then you look into do your normal profit and loss account again. We start from the sales, then we subtract all other, we bring in all our other cost of production. So the sales price variance will come in and the sales volume variance will come. Now, when the sales volume variance, which I forgot, so I computed it up here. When it comes in, it was favorable. It was favorable. So we bring in that one, and then we bring in all our material, our cost as well. So whichever is favorable will come under the favorable. Which one that is unfavorable will come under the adverse. Material price variance was adverse. Material usage variance was adverse. Labor rate was adverse. Labor efficiency was favorable. This one was favorable, favorable, favorable. So whatever we solve up there, favorable will come under favorable, and adverse will come under adverse. The same thing continued up to here. Right, so when we added all the adverse, we had 32,800. When we added all the favorable, we added 18,600. Now this is going to lead to this net adverse in the sense that when we subtract the adverse from the favorable, we are going to get this 1,4,200. When that happens, and we subtract it from our actual budgeted profits, this is going to be our actual profits, right? So this is my suggested answer for this. And now they ask us state 2 possible reasons for each of the cost variances. So it can be underestimated cost, it can be changes in supplier prices, unexpected labor challenges, and the likes. And now the other one is distinguish between idle standard and attainable standard. Idle standard is where you have a perfect kind of situation in the factory industry. no breakdown, obi anyare, or common deal, obia and the likes. Bian bisa momo unexpected and the likes. But the attainable one is where we factor in all those things. Baby sa momo, we be yale, or combat deal be what I say, So that's it. I will do another separate video and then solve the question 4. Cause the question 4 no. After me by online answer me huna no draw. I'll see you in that video. Bye.